In today's digital world, there are many amazing ways that you can make purchases. You can use a debit card, electronic funds transfers, and even your phone. With so many digital options, is there really a place in our financial world for checks anymore? While in the personal world the answer might be increasingly no, in the business world it's still a resounding yes. According to the Federal Reserve Bank, businesses wrote 4.4 billion checks in 2019 alone, accounting for over $8.3 trillion in transactions. So why do so many businesses still prefer to do their transactions with written checks? The first reason, we learned earlier, is to help reduce fraud. When you write checks on paper, it allows us to involve multiple people in the purchasing process easily in order to segregate duties and reduce the risk of fraud. Another great reason is because checks are a document, so naturally they allow us to have a source document that's related to that purchase. Now, one of the problems with having a check as a source document is that when you are finished writing the check, you're giving it away to your vendor when you make the purchase. So you are essentially giving away your source document. That doesn't help us track things very well. So in the business world, checks usually come attached to another document called a check stub. A check stub is a document that duplicates the information found on the check and is retained by the writing company as a source document for that purchase. A check stub can also contain space to maintain a more accurate record of your cash balances, since it can take up to 2 weeks or more for banks to receive checks that are written. Although most people don't think of it this way, checks are legal documents. They are essentially a legally binding contract between the payer and the payee to transfer money upon request. That's why the check uses the term pay to the order of instead of just to. This is a legal term that explains that when you are writing a check, you are giving permission to your bank to pay a certain sum of money to the payee when they order or request the bank to do it. Because a check is a legal contract, there are some specific rules surrounding how checks are negotiated. That's a fancy banking term meaning deposited or cashed. Some of these rules surround the dates written on the check. A check is only negotiable for 6 months after the date written on the check. Once the 6 months have passed, the check is essentially expired and the payee would have to return it and ask for a new one. An expired check in banking terms is also known as a stale-dated check. A check can also not be negotiated if the date on the check is written in the future. For example, let's say that I owe you money for mowing my lawn, but I don't get paid until next Friday. So I write you the check today, but date it next Friday. Technically, you would not be able to cash or deposit that check until next Friday. A check written in the future is known as a post-dated check. Even though checks have a 6-month lifespan and should not be negotiated outside of that 6-month window, bank tellers and employees can't catch every check date, and it's inevitable that checks will slip through. Banks often write into their account rules that if these situations occur, you are still responsible to pay the check. For this reason, a person or business should never issue a check that they do not have funds in the bank to cover. We'll talk more about that later. So while personal check writing might be a dying art, there is still a place in the business world for writing checks, and, as an accountant, it's important for you to become familiar with how checks function and how they are written, as they are still an important source document for many purchasing transactions. To learn more about checks, cash controls, and other accounting topics, check out more of my videos on YouTube or visit ToriNorman.com.